Building a portfolio. So in my book, I talk about a pyramid approach, and I've been using this from the very beginning. I think it works fantastic for creating diversification. Not necessarily having the best returns, but gold and silver mining stocks are very risky. So I like to diversify. So this approach uses diversification with more weight at the bottom of the pyramid to limit risk. So at the bottom of the pyramid is the base, the foundation, and this is where you want to have cash, bullion, sovereign coins. So this is kind of the very low risk. Notice there's no mining stocks here. Then the next one up is your large cap producers, and this can also be your mutual funds and can be your ETFs. I'm surprised I don't have that on here. That should be actually after the bottom. And then after that, so this is your foundation. Your foundation is basically your large caps and cash bullion and coins. Um, and you have to determine how much percentage in each of these that you want to have. But you want to have a strong foundation because these are the ones that are going to withstand, say, a 50% sell-off. And then mid-tier producers. Mid-tier producers, this is where you're going to have, I think, you want to have like 25% somewhere in there. Personally, I do. And you're going to have a lot of mid-tier, I personally am going to have a lot of mid-tier producers, both on the low end, like 100 million area, 200 million area, a lot in there, and then 3, 4, 5, 6, all the way up. I'm just gonna just have a lot of producers because really am a big fan or believer that if we have a big run, bull market in gold and silver, that cash flow is really going to get revalued. And as the price of gold goes up, as the cash flow goes up, these companies are going to have stronger balance sheets. They're going to get valued higher. Like let's say it has a 5x market cash flow valuation. It's going to go to 10, 15, 20 as the price of gold goes up. The companies are going to become more valuable. I just think the mid tiers are going to produce a lot better than your large caps. When I say large cap, I'm really talking about $3 billion, right? At least $2 billion. And so mid tiers is anywhere from 100 million to 2 billion. That's where I really want to have the meat of my portfolio. Royalty plays is another way to diversify, and some people could say that royalties should go higher than mid tiers, but I actually think that the whole royalty model makes me a little nervous. So I actually have put them at higher risk than your mid-tier producers. And then now you're going to have less. This is upside down pyramid. This is the point of the pyramid. So you're going to have a lot less development and exploration plays. And so this is where you have to decide, how much money do you want to allocate to development and exploration. Um, and I think I only have 8% allocated to exploration, and I think 18% to development, right in there. I don't have any options or futures. These are just for the experienced investors. I have done some options in the past, um, but these are for the experienced, only for experienced investors. You want to learn this stuff really well before you start doing this stuff. So you have to really have to decide, how much do I want to allocate in this area for some really big gains, if you will. I mean, you can average 5 baggers in the mid tiers, average 2 to 3 baggers here in the large caps, but you really want to, this is where you want to make some really, have some 20 baggers, even in a 50 bagger, you should get a few of these. That's why I have, quite a bit to development stories. Cost basis. Allocation. Okay, so you don't want to allocate more than 3% of your total portfolio cost basis to a single stock, unless it's a mutual fund or an ETF. ETFs and mutual funds, I think the risk level is enough where you can go higher than 3%. And it's up to you on what you want to allocate, but I think you don't have this 3% rule. But if you can, if very few of your stocks, individual stocks should be 3% or higher cost basis. It makes me very uncomfortable. I think I have one or two stocks at 3%. And the only reason they're at 3% is because they merged with other companies and I just haven't sold shares. When I first bought them at 2% and two of them have gotten up to three and I feel very uncomfortable. But you can have, one or two at 3%, but I, again, this should kind of happen by accident, or there's one stock that you really like, but you want to be really careful on that. You want to try to keep quality producers between 1 and 2%. And I only have a few over 1%. It's like quality producers, I'm comfortable with 1%. And then um, for the higher risk companies, I go less than 1%. And I actually go down to, 0.5% for the exploration plays. Yeah, I really never go over 0.5%. I go down to 1/4% on really high risk exploration plays. Allocation limits are only cost basis, not for increases in valuation. So if you have a company that had a cost basis of 1% and then it just blasts off and it's 10% of your portfolio, don't worry about it. That's all profit. I mean, you can just that's all about the only time you sell is for a reason, not to reallocate money because you have too much allocated in one stock. That's not why. You want to allocate according to risk. Um, you want to sell. Increases in valuation are pruned sold using your exit plan. So your exit plan determines when you sell a stock, not risk. So allocation is off by risk, and you always focus on cost basis allocation. That way you control your risk. Don't worry about your valuation, overall valuations. Overall valuations is has to do with your exit plan.